You write that failing to understand the lessons of history more than anything else is what dooms investors to being victimized repeatedly, cycle by cycle. And I agree, and I actually believe that goes beyond investing in so many other things. Very few people do research or really reflect. Why do you say that? Why is that so important in investing?
Most things are, especially things involving people, are governed by cycles. And, the economy cycles constantly. The life cycle of businesses. The markets are cyclical. And yet, repeatedly, people commit the mistake of thinking that trends will go on forever in one direction, that trees will grow to the sky, that something can be worth a little and that means it's going to go to zero. And these are when the biggest errors are committed by investors. As things get better and as prices rise in recognition of that, people extrapolate that. And people get more excited as things rise and want to buy them more. And people get more depressed as things fall and want to sell them more, which is just the opposite of what you should do.
The Nifty 50, I'm not sure everyone in the room remembers, Howard, the Nifty 50. We might be showing that we're over 30 by remembering.
Well, you have to go back, I guess it was about 40 years ago. You took the 50 best companies in America, the fastest growing, Xerox, IBM, Kodak, Polaroid, Merck, Lilly, Texas Instruments, Hewlett-Packard, Perkin-Elmer, Avon, Coca-Cola, etc.
Walmart, McDonald's, etc.
And you bought their stocks regardless of price because they were the best and they were the fastest growing. And so they were a little expensive. It didn't matter. You wait long enough to grow into it. And the official dictum, whether spoken or unspoken at most of these institutions, was that it didn't matter what price you pay as long as you bought the best. And the little hitch was that when I joined Citibank in '69, they were trading at 80 to 90 times earnings. And by '73, they were trading at 8 to 9 times earnings, which meant that you lost 90% of your money in the best companies in America. So that was a very painful lesson, probably my greatest learning experience. Experience is what you got when you didn't get what you wanted. But I learned a lot from it. Risk and safety have nothing or little to do with asset quality.
It's an interesting point, as Howard said. At this point in history, the money center banks, as we knew them, or the trust banks, it was a safe place to put your money.
Right.
And I think the weighted average PE into the early 70s was probably 66. And even a decade later, whereas Howard said you've lost 90% of your money, this really changed money management forever. Yeah. As Howard said, the idea of safety, if the large trust banks can lose, adjusted for inflation, 90% of your money buying the best companies, this really expanded greatly the money management business, the private money manager, the mutual fund business, in the sense that you thought you were safe and you weren't safe. And many of these companies eventually failed, like Polaroid, but many of them, as Howard said, remained among the greatest companies in America, as just their PE ratios reduced by 80%. Black Monday, 1987, Howard.
That's the day that the stock market lost, I think, 26%. Now, you think of the market being down 3% and how panicked people get. Try losing 26% of your money in one day. There was not even an obvious candidate for what caused it. You had stocks that were too high based on too much optimism. You had people who had swallowed this canard of immunization, that you could protect yourself because you would establish a policy of automatically selling portfolio insurance, buying portfolio insurance if prices started to fall, and all you had to do was sell when they started to fall, except that the brokers wouldn't answer the phone, and it built on itself. So, the lesson from that is that there's no such thing as a sure thing. My dad used to tell the story about the inveterate gambler who, always lost the rent money at the track, and finally heard about a race with one horse. So he went out and he bet all his money, and halfway around the track, the horse jumped over the fence and ran away. Not a very sophisticated joke, but the point is that there is no sure thing, and there's certainly no sure thing in investing, and when you hear about a sure thing, the best thing to do is run the other way. Well, the tech bubble was, Mark Twain said that history does not repeat itself, but it does rhyme. The themes rhyme, even though the details are different. The tech bubble was just like the Nifty 50. People believed that these were great companies, that they were going to change the world, and as a consequence, it didn't matter what you paid for them. And guess what? Collectively, they changed the world. The world has no resemblance to what it was 20 years ago, technologically, and yet, if you invested in most of those companies, you lost all your money.
Well, I think this is a really important point I just want to emphasize that Howard has made. In the late 1960s, Merrill Lynch put out a report listing the 30 companies in the technology industry, and they were recommending the computer industry would increase 100-fold by the end of the century. Mm-hmm. Out of those 30 companies, within 15 years, only one was in the computer business. So they were 100% right in the enormous growth of technology in the computer industry. However, 29 of the 30 companies they picked were no longer either in business or in the computer business, I think, from that standpoint. And I remember, Howard, at that period of time when someone would want you to invest in a technology company, I said, well, it sounds interesting. Could we read it? And they would say, well, if you have to read it, you won't get a chance to invest because it'll be fully subscribed.
Sure.
Let's talk about the recent financial challenges and crises of 2007, 2008, Howard.
People ignored the cyclicality of things and came to believe that trees would grow to the sky and believe in permanent good times. The biggest single problem I was asked by the New York Times to write an article about the cause of the crisis. They asked a dozen people, and as you might imagine, they got a dozen answers. And my answer was an article called Too Much Trust, Too Little Worry. And basically, in the years immediately leading up to the crisis, 05, 06, and early 07, people came to believe that risk had been banished, and that the combination of the adroit Fed, which could fix any problem, the worldwide wall of liquidity coming toward us from China and the oil producers in the form of excess reserves, which would constantly buoy our stocks and asset prices, and the wonderful invention of Wall Street in securitizing, tranching, and selling onward, had eliminated risk and had sliced and diced it so finely and spread it so broadly that there really wasn't much risk left. So people stopped worrying about losing money. Risk aversion is the key element that keeps the market honest and sane. And when people are risk averse, they will do extensive due diligence. They will apply conservative assumptions. They will demand compensation for bearing risk. And all of these things are very helpful. But when they forget to be risk averse and then they drop their due diligence, they stop being conservative in their assumptions, they stop demanding protective covenants and adequate returns and risk premiums, and then prices get too high relative to reality, and that's when you get a bust. And that is what happened in 07, 08, in my opinion, more than at any time in my lifetime. It happened across the board. We've seen it before in different asset classes. In 88, there were 90 disk drive companies and so forth. So people that believed that the disk drive industry held the secret to sure riches. But prior to the crisis, they felt that everything was a way to get rich easy without risk, because risk had been banished. 40 years ago, I learned one of the first of my important adages, and somebody told me there are 3 stages to a bull market. The first stage, when a few bright people realize that things can get better. The second stage, when most people realize that improvement is actually taking place. and the third stage when everybody and his brother believes that things will get better forever. And so that third stage was reached in '07, as we've seen it reached a few times in our lives. And believe me, if you buy an asset where the seller and the other bidders believe that it's going to get better forever, you're heading for trouble. And that's what happened.
I would say that when you look at these financial crises, they're really related to 4 or 5 things. One, leverage. As companies increase their leverage dramatically, financial institutions leverage 40 to 50 to 1 with the idea that that's how they're going to get rate of return.
And investors leverage.
Investors, as you said, leverage. The belief that there's some special quality of real estate. Risk. It's another area that you really cover in the book. And you've devoted it into 3 parts, kind of understanding it, recognizing it, and controlling it. Let's walk through how you look at risk and how investors, as you've pointed out a couple times here, commonly misjudge risk.
Well, number one, most people equate risk with low-quality assets and safety with high-quality assets. And they still do. I mentioned the Nifty 50. High quality, people thought, there's an old saying, you can't get hurt buying IBM. And we documented you lost 80 to 90% of your money. On the other hand, what about low quality? Is that a source of risk? When I got started in high yield bonds back in '78, I looked up in Moody's, what does it mean to be single B? And Moody's defined a single B bond as follows, quote, fails to possess the characteristics of a desirable investment. In other words, low quality asset can't be a good investment. Well, is there no price at which a low quality asset becomes a good investment? And that's what's the price. And here Moody's was saying that a B-rated bond is a bad investment. Well, what about at 75 cents on the dollar? What about at 50? What about at 25? Is there no price? And so this is the kind of herd error that you can take advantage of. So risk is not quality. And, most people believe that as something is rising in price, that means that people think better of it, it's less risky. Well, I think that when something rises in price, it becomes more risky. Most people believe that the things that everybody think are risky are risky. I think the things that everybody thinks are risky are safe because their aversion to it forces down the price to the point where it is safe and potentially lucrative. What is the riskiest thing in the world is the belief that there's no risk. Risk is perverse. That's the important thing that's what the chapter in the book talks about, it's the perversity of risk. And it's the belief, like in '07, the belief that there was no risk is what made the world risky. And in late '08, after Lehman Brothers melted down, the belief that there was no potential future is what created a great potential future.
And I think to follow up on Howard said here, the rating agencies keep the same rating on a security, whether it's 100 or 25. It might be a triple A at 25. It might be a single A at 50. One of your favorite chapters in the book. Knowing what you don't know. Okay, overestimating what you're capable of knowing and doing the extremely dangerous things rather than working within your limits. Why don't we talk about that?
Well, look, I think, Mike, and I know you agree, that the investment world is a world of excess testosterone, where people believe that they have to prove.
Well, we have women play a much larger role now.
Well, they may have it too.
Okay, good.
But people believe that it's their job to know what the future holds, that you can know what the future holds, that they do know what the future, or if they don't know what the future holds, that they have to act like they do, because if they admit they don't, they'll get bounced. And I believe that you can't know what the future holds. You can figure out which outcomes are the most likely and how likely they are, and what alternative outcomes are likely to happen and how likely they are, and which extreme outcomes could happen. And you can kind of sort the world into a probability distribution. And I think the best people in the world are the people who are best at visualizing that distribution of possibilities. But there's almost nothing in the world which is determined. Everything is uncertain. And Elroy Dimson, who's a professor at the London Business School, says that risk means more things can happen than will happen. There are very few things of which only one thing can happen. And yet people tend to invest under the assumption that they know what's going to happen. And I think that this is one of the biggest mistakes you can make. Mark Twain said, it's not what you don't know that gets you killed. It's what you know for certain that just ain't true. And I think this is very, very important. There's nothing wrong with saying, I don't know, and acting accordingly. And most people never get killed in that way. The real danger is in saying, I know, and acting on the assumption that it's correct, and then being wrong. If after this session you and I are going to drive to Barstow, and
I could, but first I have to go to Africa.
Okay. Well, but if we say we don't know how to go, then we're going to get a map, use GPS, ask directions, and drive slowly to make sure we don't make a wrong turn. But if we assume we know, we don't get a map, and not just because we're men, and we don't ask directions, not just because we're men, we don't use the GPS, and we drive fast because we're confident. And if it turns out you didn't know, then you end up in Africa. So the point is, I think that it's very important to know what you don't know and to act accordingly and to respect what you don't know. And the point is, you don't have to know the future to be a good investor, and especially the macro future. Today there's a great belief that macro rules the markets. And so you should figure out when the Fed is going to let interest rates rise and stop stimulating, what's going to happen in Europe in terms of its staying together and how it bails out the peripheral countries, and how low China's growth rate goes. That these things are the things that are going to move the market, and so that's where you should spend your time. Now, the interesting conundrum is that in the short run, they are the things that are going to move the market, but I believe you can't know them. And if you can't know them, then you're wasting your time trying to know them, and you should know the knowable. And the knowable consists of getting an advantage versus other investors with regard to companies, industries, and securities. And these are the things where hard work and skill will pay off, and these are the things you should spend your time on.
Now, Howard, to follow up on the point you're making, when you go to school and business school or other things, you constantly use regression analysis. And so, and underlying this issue that Howard's just pointed out here, that regression analysis tells you what the future is based on the past.
Right.
And if you remember, Howard, back in the 70s, a company that had been paying dividends for more than 120 years, Singer Sewing Machine.
Right. Sure.
So they were rated single A, and they sold bonds into the marketplace in January of 74 in this example. And obviously, if you looked at the past, Singer had growth. But the future, as Howard identified here, the risk, well, it's the emancipation of women in the 1960s and 70s. Possibly women wouldn't be home sewing as much as they were. And maybe the future for Singer would not be the same as the past. And as a result, those bonds traded at 35 within 12 months as people discovered that. And I think this point, I just want to stress this chapter, knowing what you don't know, is so important, because if you're interested in the financial service industry, what Howard just said, it isn't losing money where you thought you were taking risk. It's losing money when you didn't think you were taking any risk that really changes behavior. And it was the Nifty 50 in the 70s that really changed that it was not safe just leaving your money in the trust. And it was really this period of time in the late 80s, and again, that what you thought was safe. You lost money in AAA bonds. You lost money in money market funds, whatever it might be. And that is really what changes behavior, because you were trying not to take risks.
Which used to be on TV. And they said to me, how can you invest in junk bonds when you know some of them are going to go bankrupt? And for some reason, the answer came to me. And I said, look, the most conservative companies in America are the life insurance companies. How can they insure people's lives when they know they're all going to die? But how do they do it? Number one, as you say, the key, it's risk they're aware of. They know they're going to die. It doesn't come from, oh, we had somebody die. Number two, it's risk they can analyze. So they have you get a physical. Number three, it's risk they can diversify. They don't only insure people on the San Andreas Fault or only skydivers or only smokers. And number four, it's risk that they can get well paid to take. If they figure you're going to die at 80, then they sell you a policy based on the assumption that you'll die at 70. And if you die at 80, they come out okay. And if you die at 70, it's a bonanza. So the point is that if you understand risk and you're aware of it, you can price the asset right and you can get a bargain.
So let's pick up, Howard, on this point you've just made, maybe paraphrasing it. A life insurance company has done their analysis, no different than you do credit analysis, and attempted to figure out what your life expectancy is based on statistics. As we improve our treatments, your life is extended. So if I've sold you life insurance, it's a real positive for a life insurance company because you're living longer. If I've given you an annuity that's going to pay you as long as you're going to live, then I'm on the other side, and then I'm going to pay you longer than I expected. But they're attempting to analyze what they conceive as risk.
At our firm, we don't run our investments based on predictions for the macro. But that's a challenge because what is investing? It's making decisions with regard to the future. It's positioning a portfolio to make money, hopefully superior money, in the future. So if your job is dealing with the future and you can't know the future, does that mean it's a wreck? And what I believe is that we never know where we're going, but we sure as hell ought to know where we are. And we cannot very helpfully know the future, but we can very helpfully understand current conditions. And what we try to do is what I call take the temperature of the market and understand the climate and assess primarily the behavior of the market participants, and that tells us what to do. My favorite quote is from Warren Buffett, who said, the less prudence with which others conduct their affairs, the greater the prudence with which we must conduct our own affairs. If other people love securities and can't imagine a way to lose money, then we should be terrified. And if other people hate securities and are terrified of the future and can't figure out a way to make money, then we should turn aggressive. We don't have to make a guess about the future in order to figure out how to position our portfolios. The tips that we get from observing the behavior of others and inferring what it means, that's enough.
Let's talk about something that you often don't talk about when one talks about investing, and that's luck. Okay? Appreciating the role of luck.
Well, the future, I think this is one of the most interesting topics. The future does not exist. The future is only a range of possibilities. It's not like there's some event in the future which is going to happen and that event exists in prospect today and it's predictable. There are lots of different things that can happen in the future. And given the fact that, as Dimson says, more things can happen than will happen, we have to understand that in large part, outcomes will be governed by luck and randomness. And there's an excellent book called Fooled by Randomness, written by Nassim Nicholas Taleb, which talks about the world in this indeterminate sense, and which Number one, if you read it, I think you'll be convinced that you, number one, don't know what the future holds, can't know what the future holds, shouldn't behave as if you can know what the future holds, and maybe more interesting, it will convince you that when you look at past events, you see, there's a tendency to say, well, yes, the future is indeterminate, it hasn't happened yet, but the past is over. That's history. And we know what happened, we know what to make of it. But the point is that the past was in large part determined by luck. And Taleb uses the example of the famous investor. And our industry is full of people who got famous for being right once in a row. When you couple that fact with the fact that much of history was the product of randomness, then you understand that history may not tell us anything. You look at the record of an investor who had a great year, it doesn't mean he was a great investor. It means maybe he got lucky. Maybe he took an outrageous position in his portfolio and was favored because something that had no right happening happened. We have a mutual friend, Bruce Newberg, and Bruce and I play a lot of backgammon. And he often hastens to point out that improbable things happen all the time. And likely things fail to happen all the time. So when you see a result, you don't know if it was luck or skill until you see a long string. If somebody can make decisions, 100 decisions, and get 70 of them right, or 80 over a long period of time, then you can start to believe that it's skill and not luck. But you know, I think that there are 3 ingredients in success, Mike: aggressiveness, timing, and skill. And if you have enough aggressiveness at the right time, you don't need much skill. But you know, in the long run, luck, and especially the luck of good timing, gets washed out. And that's when skill comes to the surface. Alternative histories, which is the other things that reasonably could have happened, but didn't. And when you look at even history, you have to be aware of that possibility. Was Alexander the Great great because he was a great general and strategist, or did he say, I'm sure it's going to rain, and it rained, and that made him a winner? In which case, could he do it again? So some things are a waste of time, and some things are knowable. And yes, hard work and skill will pay off on the knowable and not the other.